Today's show is brought to you by Crane Shares, creator of the Defined Outcome Buffer Strategies, KPRO and KBUF. Chinese equities were one of the top performing asset classes in the world last year, but a lot of investors are looking for downside protection and a way of better defining their potential risk. That's why Crane Shares created two defined outcome ETFs based on their flagship Chinese technology ETF, KWEB. KPRO offers a 100% downside buffer on KWEB with an upside cap of 20% based on the new outcome period reset over the next 12 months. This allows investors to capture growth in Chinese internet stocks while eliminating downside risk. KBUF is the same thing, but a 90% buffer and a 40% cap. You need to learn more. You need to check out craneshares.com. Ladies and gentlemen, welcome back to What Did We Learn? I feel like we're learning every time we do this. I am so excited for my regular check-in with DataTrek on the Compound's YouTube channel. I'm here with my friends Nick Colas and Jessica Rabe. Nick and Jessica are the co-founders of DataTrek Research, the authors of DataTrek's Morning Briefing, which goes out daily to over 1,000 institutional and retail clients. They are also two of the smartest people I know. Nick and Jessica have their own YouTube channel, which you could find a link to in the description below. I didn't know we were going to have to talk about tariffs as recently as last week, but this is the world that we live in, and that's really all that anyone is talking about this morning. And let's talk about tariffs. Should I panic now or later today? Like, what would be the right schedule for flinging myself out a window be if you were me?
Oh, just close the window, enjoy the view. It's going to be fine.
You sure? Okay.
Yes.
All right. I was all lathered up. I want to introduce the topic very quickly with a TLDR version. And you guys are listening to this for the first time Monday afternoon. So, of course, many things could have changed between now and then. But Trump announced 25% tariffs over the weekend on Canada and Mexico. He said they're effective Tuesday unless those two countries, two of our biggest trading partners, do something about fentanyl and illegal migration across the border. Then he made some economic arguments to justify trade, things like trade deficits that have always bothered him. No one really knows the end game here because this isn't rooted in any specific policy goals per se. I think what these countries need to do is play along. And he's always just liked tariffs is the important thing to keep in mind here. He liked them in the 1980s when Japan was ascendant. He liked them in the last term when he was complaining about NAFTA and China. He likes them now. He will never completely take the threat of a trade war off the table. This is just going to be part of the ambient noise of the market over the next 4 years. And we all kind of have to get used to it. Guys, I want to just throw up a quick chart of the reactions as of this morning. So you can see we immediately sold off before the market opened. And ever since then, markets have been steadily recovering. I'm showing you here S&P, Dow, NASDAQ, basically barely down. The Dow looks like it wants to go flat on the day. And then the last thing I'll just pop up here. We got word from Donald Trump that he's already talking with Claudia Sheinbaum of Mexico. I have to read a little bit more about why they have an old Jewish lady from the Upper West Side as their president. But Claudia Sheinbaum had a very friendly conversation wherein she agreed to supply 10,000 Mexican soldiers on the border, separating Mexico and the U.S. Therefore, tariffs off as we achieve a deal. So obviously the market's like that. Chart off. I mean, guys, it's the same reality show from the last term. I don't know why we're treating it as though it's something different than what we've already lived through. What are your thoughts?
Yeah, that's totally fair. I mean, this is not a surprise in the typical sense of the word in terms of what happens to Wall Street. We've known what Trump's policies were from the first term. We knew from the whole election cycle last year. So none of this feels like any kind of great surprise. Timing's always going to be a little bit of a surprise. And okay, doing it on a Friday, the last day of the month, maybe not the best idea, but still we're here and markets are dealing with it as they always do. I'll just toss out one piece of kind of trivia. Since 1990, when the VIX first was launched, of the 100 lowest VIX closes, 80 were in Trump's first term. So for all the reputation that he has about roiling markets, the track record is something entirely different.
Yeah. I think that's probably because it's hard to keep shocking people over and over with potential negative outcomes that never actually happen. Now, they did actually do the tariffs last time, and there were obvious negative consequences, both in terms of GDP, but then also like specific sectors. But to your point, that still didn't equate to being a more volatile than usual period of time. That's over the entirety of the presidency. There were volatile days would probably be the way I would phrase it.
There were volatile days, but the VIX was very often below 20. And the only two noticeable vol spikes during Trump's first term were both rate related. They were in Q1 and Q4 of 2018 as 2-year rates began to climb because the Fed was talking about hawkish, neutral rates. And again in Q4 when markets really melted down. But you can't really point to either one of those being, Trump's fault.
I want to show you a couple of charts by Chart Kid Matt from my shop about what people would be worried about if we thought tariffs were about to seriously not only be announced but implemented and then stay in place. This would be the core PCE inflation outlook, and this is data coming from Russell Investments. They're showing you basically the flat blue line is the baseline for the inflation outlook with no tariffs. Then there's a baseline with tariffs, and then a high-end tariff scenario where these countries do not negotiate and we keep ratcheting up and the rhetoric turns into actual policy. And you could see that high-end tariff scenario leads to a spike sometime around the end of 2025 into like the 3.6% core PCE, which of course headline would be even higher. The next chart is the effects on real GDP. You could see a pretty big drawdown if the tariffs, as promised, become the baseline and are implemented. The high-end tariff, obviously, significantly worse. And then the next chart, this is just the tariff rate on U.S. goods, the average tariff rate on U.S. goods, imports for consumption. So you can kind of see that dotted line on the right. That's the proposed 20%. And right now, of course, we're somewhere just over 2%. We've settled out at. So it's a really big difference if the stuff actually happens. But the if part, guys, is the big if. So any feedback from clients over the weekend or any questions that you weren't expecting to get when you saw these headlines start to cross?
Not really. I mean, the issue we were addressing all last week speaks to the charts that you just put up, which is what effect do tariffs have on inflation and therefore Fed monetary policy. And it's been interesting over the last couple of Powell press conferences that this very arcane document called the Teal Book, which is a briefing document the Fed staff puts together for the Fed governors ahead of meetings to help them decide on monetary policy. Back in 2018, they did a whole study on that inflation chart, and the numbers are pretty similar to what you put up there. Tariffs actually spike inflation. It was a huge topic in 2018, huge topic now. Yeah. And the recommendation to the Fed was not to raise rates because it was a one-time inflation shock, and raising rates would just cause a recession, and seeing through them would eventually see inflation come back down to normal. So in terms of the interplay between what we're seeing here and what the Fed's been talking about, which is a big issue for our clients, so far the color has been they're more likely to see through it than they are to act on it and try to dampen inflation due to a one-time, effectively a shock.
Jessica, what are your thoughts on the topic?
I'll just speak to my cohort. So I'm 30, anyone 35 and younger, don't worry about what, one president over the span of 1 month does with 3 countries. This is just a blip in the radar relative to our investment horizons. So just stay the course, stay through the volatility, look for some productive entry points if there are any. And we'll think Nick's going to speak to that a little bit with the VIX later. But yeah, just stay the course, and find a productive entry point and just look past this.
Nick, you guys have a framework where the question to really ask yourself is this negative catalyst going to materially change? First of all, is this really a negative catalyst if it happens? And then if it is, how negative? Is this going to materially change the course of the markets? And you kind of go through a playbook for these negative market catalysts. Do you want to, I think we could put these rules on screen. Do you want to walk us through this idea?
Yes, this is, not to be too dogmatic, but we look at every market shock kind of the same way, and we run through a checklist of questions to determine how much we should worry about it. So it's basically 4 items. The first is, does the negative catalyst have a material effect on the economy? Does it increase the risk of recession? The biggest thing that happens usually is you get an oil price shock, and this happened in 73, 79, 1990, a couple of other times. Prices double in a year. That affects consumer and business confidence. We get a recession. You can also get fears of a recession from aggressive Fed policy back in 2022. So question number 1, does it increase the risk of recession? And I would argue that so far from what we've seen, the answer is no. These tariffs are an annoyance to markets, but they don't really put the economy on a tipping point into a recession. Things can change, but I seriously doubt Trump wants to see a recession in his second term in office. So he's going to be careful on this point, as erratic as he might sound. The second is,
let me break in for a second. Chart off for one moment. We are though talking about the auto industry, and oil. So having tariffs on Canadian oil and gas products that are above and beyond the other tariffs, and then having Canada recognize that may actually be an opportunity to retaliate against us. I'm not saying this could in and of itself cause an oil shock, but directionally it's not great. And then on the southern border, a lot of auto manufacturing revolves around back and forth commerce between the U.S. and Mexico. And of course, autos and auto manufacturing is a highly economically sensitive sector with tons of employees and lots of economic activity that can be affected like throwing a stone into a pond. We don't necessarily know where those ripples stop. So the answer to your first question is, does it materially increase the risk of recession? I sort of feel like you would say, well, tell me for how long it goes on and how extreme it gets before I can really answer that.
Yeah. So on your 2 points, on the first, oil prices have to double before you get a recession. The history is super clear on that. And we're not talking about a doubling of oil prices. On the second point, the last time the U.S. auto sector, a sector very near and dear to my heart, having covered it now for 30 odd years, is that the last time an auto shutdown had an effect on the U.S. economy was, I think, September 1998. There was a 54-day strike at GM, and GDP got clipped by 0.3%. 0.3 percentage points. So yeah, automakers important to the economy, but even less so now than in 98. And even in 98, a very long, full-blown, no production strike at GM only hit GDP by 0.3. So not as important as it used to be. And while the headlines are there, maybe not as important as people say.
Okay, chart back on. Rule 2.
Rule 2, does it affect financial stability? Does the negative shock affect financial stability? And the examples here are the 97 Asia crisis, the 98 LTCM crisis, 2008, obviously, 2011 Greek debt crisis. And I would say no one's arguing that tariffs are going to create any kind of instability in the financial system. So no on that point. The third point is, how do policymakers respond to the catalyst? In this case, the policymakers are the catalyst. So that's the one area where it is a negative catalyst with no clear address. You're not going to get a countervailing effect from other policymakers. So there's the risk. And then finally, how do U.S. markets respond? And we look at the VIX. Jessica mentioned this. There are 3 levels to watch. 19.5 is the long-term average. We just ticked over that this morning and fell right back down. 27.3, 35.1, and 42.9. So rounding to 27, 35, and 43. Those are 1 to 3 standard deviations above the mean. The more severe the VIX, the more severe the response, the higher the VIX goes, the more likely you get a policymaker response. And this goes back to literally the start of the VIX in 1990. When that volatility gets that high, policymakers act. They always do. So I think Hitting 20 on the VIX this morning is not a signal that the administration has to back off immediately. It's probably a sign that they're okay, that they've communicated these policies accurately, and the market's not all that surprised. And going back to our prior, what did we learn? The only thing that affects stock prices is surprise. Should we be surprised by what happened? Probably not.
He ran on this.
He ran on it, and he's delivering on what he said he would do.
Yeah, the surprise is that he's actually doing it, and he still hasn't actually done it, by the way, I should point out. The surprise is that he's starting within the first 2 weeks of his administration, but the surprise is not that he likes tariffs. I mean, that's fairly clear. I thought, look, there's a lot for us to talk about. The reaction in Bitcoin is like a whole other tangent we could go on. It turns out Bitcoin is basically in the Magnificent Eight. It's the eighth holding, and people are starting to learn something that we've all been saying for a little while. The non-correlation goes away right when you would want it. But that's a whole other topic. All right. I want to talk about the DeepSeek stuff because you guys do write a lot about innovation, and you write a lot about the reason why in the United States economy, the upside surprises are the thing that have driven markets, and those upside surprises frequently emanate from innovation sectors of our economy. I haven't spoken with either of you about the events of last week with the surprise from China that there may be a large language model that cost under $10 million to build, which maybe isn't true. But what was your reaction, and what do you think is relevant to investors now?
Yeah, so I mean, we got actually a couple of slides because I think this concept of disruptive innovation is super important, but it gets so badly abused in the common use that I think it just deserves a quick reset. And so people, viewers can pause and just read these slides. I'm going to blow through them pretty quickly, but there's more details in them. Clayton Christensen, who was a Harvard Business School professor, coined the term disruptive innovation. And he said it's a very specific thing. It starts with a small company with very limited resources entering a market with a low-cost product that targets underserved consumers and uses a new technology to give them an edge. The incumbents, the people already in the business, recede from the low end since it's very unprofitable anyway. They don't really care. They can make better money, better returns on capital by moving up the value chain and not really focusing on the low end, which they don't really like to serve. So that would seem to be a win for them. But the problem is over time, that disruptive company moves up the value chain, starts adding products, starts adding features, starts adding services, and that product gets better and better and better. And the incumbents continue to cede that ground and move even further up the value chain. And eventually they disappear because the incumbent's taken over the entire market and the whole process starts over again. A couple of examples from that on the next slide. And these are just go back just to show you that this is not just technology. This is not just Moore's Law. This goes back 100 years plus. Sears Roebuck killed the general stores in the first half of the 20th century because rail finally connected the country and allowed for shopping and shipping a wide variety of products marketed by catalogs, and it killed the general stores in this country. The Japanese automakers versus Detroit, same story. In post-war Japan, they didn't have a lot of resources, so they figured out a new way to build cars and trucks, and they did it with continuous improvement and building affordable small cars. The minute the oil shock happened, first in 1970 and more in 73, 74, they walked in and took the low end of the market in the US and then improved their products over time and gradually killed the big three. And that happened over 30 years. And then finally, we know Amazon. Amazon's the one that finally disrupted Sears Roebuck, doing the internet to sell books and then everything else. Books were an underserved market and everything else came along afterwards. So this paradigm of starting at the low end and moving up, this is the paradigm of disruptive innovation. That's how it works. And the final chart just shows you DeepSeek versus USAI, and particularly ChatGPT, and it fits this role to a T. DeepSeek is the disruptor. It's a cheaper offering, good enough product, potentially compromised with Chinese ownership and in-country hosting, but still good enough for a lot of users around the world. ChatGPT is the incumbent, super well-funded, relationship with Microsoft, the power base right now. AI is a fast-growing global market, so in theory, there's room for both Chinese and USAI, but the risk to USAI is that DeepSeek keeps getting better, which it will, and other China-based disruptors enter the market as well, which is super likely. And there's a lot of parallels to the US auto industry, honestly. And again, this is my touch point to thinking about disruption, because you have insular management who thinks they can do no wrong. Their temptation to retreat to the high end of the profitable upper segment of the market with Microsoft is very likely. And you end up in a situation where OpenAI is GM, and DeepSeek is the Japanese auto companies, and that paradigm fits extremely well. So,
guys, this stuff is like 2 years old, and we already have incumbents being
yes,
the minute you displaced.
The minute you raise $100 billion, you are by definition the incumbent.
Okay.
And then people can chip away at you. So that's the paradigm we think about. It's a super important topic. I mean, this is
look, I think we have, like, even in the last few years, we have like really obvious examples. And one of the things that this disruptors always have in common, they don't shy away from the fight because they're the David and they're up against the Goliath. They use the Goliath's own weight against it. And so like Amazon disrupting Sears, like Sears had the weight of all these retail locations, and Amazon was able to use that against them. Well, we don't have those retail locations. We can go way below your cost, and pass that cost along. We're seeing that with Robinhood right now in the brokerage market, and the move upstream. Robinhood made an acquisition in the RIA custody space just before the end of the year. So they start out as a toy, and everyone laughs and says, "Oh, look, it's Robinhood, LOL." And now they want to be in the wealth business. It didn't take long. So we see examples of that sort of thing all the time. Is the takeaway, though, for investors, what if all of this investment being made on the part of Microsoft and others turns out to have been, I don't want to say wasted investment, but not as profitable in the future as we once thought it would be, now that you've got these players at the low end that are effectively piggybacking it?
I think
sorry, Jessica.
Please go ahead.
Yeah, go ahead.
Those are sunk costs. The market is focused on the future. I think what's more important is that January showed the market understands that cheap AI is not an existential threat to U.S. big tech, and that it might actually help. So, for example, we have a table of the breakdown of big tech's contribution to S&P returns over the last 2 years in January 2025. And just 3 quick points here. First, as you can see in the table, big tech was a wash in January in terms of its contribution to the S&P. So although, of course, NVIDIA was a drag, Meta, Google, and Amazon more than offset its effect. And second, in fact, even after all the news about DeepSeek, Amazon made a new record high on Tuesday, and Google and Meta did on Friday. And the third point here is this is a benefit of index investing. If sentiment around NVIDIA continues to worsen, it'll have less and less of an impact on the S&P. And at the same time, other names that will benefit will play a larger role in the index. And now U.S. big tech companies like Meta and Google can spend less on building out AI infrastructure and more on creating useful tools that they can monetize to their large global customer base. And from an investor standpoint, cheap AI means a lot more capital to return to shareholders through stock buybacks or dividends. So Meta, for example, spent $28 billion on AI in 2023, $39 billion in 2024, and it plans to spend between 60 and 65 billion on AI this year. Everyone's probably seen those headlines. And even though Mark Zuckerberg said DeepSeek doesn't plan to change, won't change, even though Mark Zuckerberg said DeepSeek won't change these spending plans, the company's certainly going to have to consider adapting if cheap AI proves useful and monetizable. I mean, our bottom line here is we need cheap, ubiquitous AI to create killer apps that make Gen AI a useful daily tool for people as opposed to just a cool technology. We really think that's what's been missing since ChatGPT debuted in late 2022.
Yeah, let's put this dispersion chart. So this is dispersion in Mag 7 year-to-date returns. Now, of course, some of these companies have reported earnings and some haven't. But so that's some of the price action that we're seeing here. But some of it is in the response that we just described to the launch of really cheap AI, really like productive, low-cost AI. Meta is the best performing name as of the end of last week in the Mag 7. NVIDIA is the worst. Who has the most to lose as these technologies become more widely available and you need less compute? Who has the most to gain? Meta among these companies has the large language model that was already open source, and was not seen as going to be a huge source of profits on a standalone basis. So I think, Jessica, that's really the salient point here, is that it's not good or bad. It's good for some, potentially bad for others. And this follows most waves of disruption in that it's not immediately clear, that these companies should be trading up and down together. Once we see that dispersion, like, why wouldn't it remain dispersed? So that was a big takeaway from me. And then I guess I would ask you guys, is this a Sputnik moment? Or, as you phrased it, is it just another Marlboro Friday? What do you mean by that? And how are you feeling a week later, now that we're more worried about tariffs than we are about DeepSeek for a change?
And the news cycle is whipping around, that's for sure. I mean, the difference between the Sputnik moment and Marlboro Friday, the Sputnik moment was, when the Russians launched Sputnik, the U.S. freaked out because they thought they were way ahead in the missile race, which was basically the intercontinental ballistic missile race. The Russians showed that wasn't the case. And it really, created NASA, and it created a lot of focus in the U.S. on getting better at technology. So it was healthy, but it was a shock.
It led to the moon landing, like, within the decade.
Yeah, so it helped. It helped propel innovation, and hopefully does the same thing here. Marlboro Friday was this thing in the 1990s where all of a sudden one day, I think it was in 1993, Philip Morris cut the price of Marlboro cigarettes by 20% in a day because they were losing market share to generics. And the stock was down 26%. They just got crushed. It was one of the more dramatic moves of the entire 1990s, of a big super cap stock with massive competitive advantage. And people were writing about the death of consumer packaged goods for the next 2 years, that no CPG company can hold price, brands don't matter. But here's the thing, Marlboro, basically bad call, because CPG continues to be powerful, and Philip Morris doubled over the next 3 years from that puke. So I tend to think of this more as a Marlboro Friday moment, with some of the comments that Jessica made about disruptive innovation affecting companies differently. There are going to be some clear winners, but this isn't, the death of a theme the way people thought it was about Marlboro Friday.
Okay. Another corollary that I thought of, when people used to say, is high oil, is it good for emerging markets or not? And you would say, well, the BRICS, 2 of them are oil exporters, 2 of them are importers. What do you mean, is it good? Great for Brazil, I guess. Not so great for India.
Yeah,
okay.
Awesome for Russia.
Right. So there's too much nuance for the algorithms that will buy and sell on a headline like AI giants disrupted by China. There's way too much nuance for that easy of an answer to ever give you a durable edge as an investor. Because then there's the second order effects, the third order effects. I think that's a really good reminder. Guys, I want to get to this thing Jessica's talking about. If tech goes out of favor, growth-oriented investors should show incremental interest in healthcare. Funny you should say that. I just pulled the trigger on a pharma stock that is technically breaking out, 15 minutes ago. So good timing. I look at the stocks that are working. I have a bias toward the 52-week high list, not the 52-week low list. I'm seeing more healthcare on there than I have in a while. Last year was a terrible year for the healthcare sector relative. Talk to me about what you're looking at here.
Sure. Yeah, we wanted to end on something actionable. So, with concerns over U.S. large cap tech's high multiples and now this Chinese AI competition, we think U.S. large cap healthcare should outperform because growth oriented investors will look at it as an attractive option versus big tech. So, healthcare was actually the best performing sector last month in January. It was up 6.8% versus a gain of 2.7% for the S&P, and actually a loss of 0.7% for tech. And of course, there's the government policy uncertainty with this trade, but I'll just quickly lay out the bull case here for what is rather a contrarian call, because as you said, it had a horrible year last year. So if you could just please put up the first chart. So this shows the 1-year trailing relative price returns for large cap healthcare using the XLV ETF versus the S&P from 2000 to the present. So when the blue line's above the x-axis, that means XLV has outperformed the S&P by the amount shown on the y-axis and vice versa. And
so it's been a while.
Yeah. I have just 3 quick points here. So healthcare on average has performed in line with the S&P over any given 1-year holding period. In fact, it's slightly outperformed by 0.3 percentage points. And the standard deviation around that mean is 10 points. So you can see on the chart there, we noted the 3 standard deviation downside level, 29.9 points, with a dotted black line. Now, second, healthcare's only come close to 3 standard deviations of downside performance twice over this period. So the first was, as you can see in the chart, was on April 6, 2021, when XLV had underperformed the S&P by 29.1 percentage points over the prior year. That was due to tough comps from the start of the pandemic when the group was on fire. Over the next year, large cap healthcare did go on to outperform the S&P by 12.1 percentage points. And then the second was actually earlier last month on January 6th, with XLV underperforming by 27.6 points. Since then, healthcare has outperformed the S&P by 5.6%. Since then, healthcare's up 5.6% versus the S&P is up just 1.1%. And the third point here is these two instances are mathematically similar. They do come against different backdrops. So, of course, in 2021, healthcare stocks were comping against pandemic era strength when people were looking for reopening trades. Now, healthcare has been lagging since the start of the current bull market. So, since the S&P's low in October 2022, XLV's only up 21% versus the index gain of 69%. Now,
That's a huge performance disparity.
Yeah. So we're looking
even for this,
here.
Right? Even for any other sector versus tech, this is as big as it gets, right?
Yeah. So it's pretty big disparity, and even on top of that, so we're thinking of, okay, so what's going to be the catalyst that might spur investor interest in healthcare, other than just that deep underperformance, as you just pointed it out. And 2 thoughts here. The first is that healthcare only saw 3.9% earnings growth in 2024 on 8.3% revenue growth. So, of course, negative operating leverage is a major reason stocks or sectors underperform, even without the policy overhang that came into play after the November U.S. general election. However, over the next 2 years, Wall Street analysts are actually looking for positive operating leverage. So revenue growth in 2025 of 7% should translate into 21% earnings growth. And for 2026, 6% revenue growth is expected to create 10% earnings growth. And even if you think those numbers are a reach, if you could please put up the next chart. While those estimates might be reached, healthcare trades for only 17.8 times 2025 earnings estimates. So that's far below the S&P's 22 times and tech's 28 times. The only cheaper sectors are financials at 17.3 times and energy at 14.3 times. So the bottom line here is we agree with you, Josh. We just picked a stock, but we do think this sector is a good trade. If large cap tech continues to be out of favor, healthcare should continue to outperform, we think, from interest from growth-oriented investors. It's dramatically oversold, and it has a history, albeit limited, of bouncing back when it's this deeply discounted. And we saw some of that already in January.
So this is the third cheapest sector on forward PE, selling at a below-market multiple. It is currently coming out of an historic level of underperformance relative to tech and the overall market. Is that fair to say? Okay. Mm-hmm. Higher than average dividends versus the other 10 sectors. Higher than average profitability, excluding biotechs, I would guess, give or take, right? And somewhat defensive characteristics historically. The healthcare sector, not all the names in the sector, of course, are defensive, but more defensive than anything in the tech sector. I think we could probably argue. All right. Do you think we could get into a scenario where, like, negative days for tech, you could almost like close your eyes and bet you're going to see green on the screen in these stocks, or is it not quite that black and white? What would you
Yeah,
guess?
you tend to see growth, like I said, you tend to see growth oriented investors, swap into healthcare from tech.
Okay. I like it. And there's, I don't know, hundreds and hundreds of stocks in this sector, depending on how low you're willing to go down in cap size. But there are no shortage of companies that you could take a look at if you are underinvested in healthcare. Super actionable. Thank you for that.
Yeah, and in January, the only down sector was tech, and the best performing sector was healthcare. Like, what else do you need to know?
I would say let's keep this our secret, but we are on YouTube, so the secret is out. Nick, Jessica, thank you guys so much for joining us. I want to remind everyone, if you want to learn more from Nick and Jessica, they have their very own YouTube channel. It's youtube.com/@Nick Colas and Jessica Rabe. And of course, you can subscribe to their research at DataTrek Research.com. Thanks, guys. We'll check in with you soon.
Thank you so much.